Well, this week we're looking at market returns for the first half of this year. The end of June has come and gone, and after 3 years, the European crisis hasn't gone anywhere. For the first 3 months of this year, it looked as if the world economy would again find some footing, but this is all evaporated in May, and Greece and Spain are yet again taking a centre stage. In fact, Greece made a formal request at the end of June to the EU to access Euro funds, and of course Spain also, we know, looking to get a funding and bailout funding from the EU. So what lessons can we take from the first half of this year, and what does this mean for your returns going forward? Let's just take a look at how the market has performed. So here are some numbers to consider. The JSE All Share has gained roughly around 5.6% since the beginning of this year, where the S&P 500 over in the United States has gained around 5.7% in dollar terms, of course, over that same period. Nothing to really write home about, of course, but it's still a positive return, and it certainly does put into perspective all the negative news that's dominated headlines. But not all markets have closed first half of the year in the green. For example, the UK market, the FTSE 100, has ended down by around 0.3%, so giving up some gains there. But of course, that's all in the past, so what can we expect from the rest of this year? Kobe, let's focus in firstly on South Africa, because as I said, 5.6% return. You're looking at a world right now where everyone's looking at perhaps an Armageddon situation taking place in Europe, China slowing down, we continue to have negative news flow around Europe, yet we're still sitting in positive territory right now. Does that mean South Africa has been somewhat defensive?
I think so. I think South Africa has certainly been defensive up to this point. I mean, there's been pockets of defensive stocks. I don't think all of it has been defensive. There's certainly been areas that have sold down quite aggressively. Resources, obviously, being a prime example of that. But the interesting thing to take into consideration is if you're an investor and you've been sitting on the sideline, you've had no capital committed to equities, and that means you've literally done no buying whatsoever. You've missed out on this proverbial 5.7% return in the markets, and inflation, for the full 12-month period is up by about 6%. So hence, you were able to kind of gain returns regardless of all the volatility and everything that you've kind of seen over the period. As a matter of fact, if you look at the moment, there is a return for the JSE All Share, and you can see how the JSE All Share has kind of looked since the beginning of the year. You can see kind of a fantastic run-up in the market, and it's kind of gone flatlined. A kind of more of a run up here towards kind of June 2012, and there you can see the fall down in returns. And if I just fast forward a little bit, there you can see the UK market, and you can see there, you can see the returns are below the point that you started at the beginning of the year. Obviously not as great as South Africa. There's the United States, and you can see exactly the same type of picture. That's as earnings continue to come through in the market. You can see the earnings coming through there. And then as it slows down and the sovereign crisis in Europe kind of takes center stage again, you can see how returns kind of slowing down again. And there's the MSCI World. That's now in dollar terms. This is the Morgan Stanley, the composite index of world equities. And you can kind of see where that's ended for the year. Roughly about 1.4% up for the year. I mean, Roland, at the beginning of the year, we kind of had a similar talk about how do we see the world kind of planning itself out for the next 12 months. And I think some of the estimates were kind of saying that South African equities could potentially do kind of upwards of 20% for the year. How's that going as far as an assumption is now?
I haven't seen numbers as high as that at the beginning of the year, but sort of from 10 to 15, so mid-teens were the sort of forecasts. We 5% up, 6% up from the beginning of the year, so if there's another 7% by the end of this year, you're sort of in your mid-teen kind of range. So it's probably still doable. But it's clearly the story is Europe, and it's a bit of a binary event. If Europe sort of recovers and sorts its problems out, we're going to see a sharp run-up, and if it doesn't, it's going to get a lot worse than it is. So I think globally the consensus very much is that volatility is going to continue. I think this EU summit, which we're waiting for, is critical. But remember that the South African market has been driven by two things so far. It's been driven by an emerging market kind of overweight. So I don't think there were many domestic reasons why South Africa did that well. But emerging markets generally had more growth than developed markets. So we saw that underpin. And then within South Africa, there's been a very strong consumer kind of effect with higher real wages and the retailers doing really well. Industrials have done relative to resources at least, done quite well. So those two underpins have supported the SA market. The question is whether those two factors are going to continue going forward, and the probability is probably less so than at the beginning of the year. So I think the second half is going to be quite quite weakish.
Just let's go back to the comments you had about emerging markets, because, for example, Citi says South Africa is quite a defensive market when it comes to emerging markets. They've got South Africa as a whole as a buy if you're looking to get that kind of emerging market exposure. And South Africa also considered to have positive metrics when it comes to specific companies here. Generally a higher dividend yield, generally higher cash on the balance sheets of South African corporates. So there are some quality assets in South Africa, and I think that's also another factor that made South Africa, on a relative scale, one of the more defensive, risky emerging market assets.
Yeah, the domestic, what's interesting about the second half of this year is we're going into the same kind of situation as the US in terms of electioneering. And generally markets just sort of sit and watch. They don't really take a view when there's all this posturing and political rhetoric happening. So that's another reason why the second half of this year could be quite slow. But coming back to South Africa within the emerging market context, just think about South Africa as having, or Europe, suffering from these expected austerity measures, whereas in South Africa we've had the exact opposite. We've had actually salary increases above inflation, at least in the past, which has come through in the system, and that is why people have seen South Africa as a growth opportunity. It's probably a shorter term growth opportunity, but there's higher real wages here, which is the exact opposite of what's happening in Europe.
Yeah, you know, we've got to be careful when we say that South Africa is a defensive play. You know, South Africa is, if you just go back in history and you just have a look at the data, you'll see that we've got strong PE reversions in this market. So as the market runs and runs and runs, at some point the world decides, look, this thing can't go any further, and then it just reverts very, very quickly. And this happens in a moment, and it can happen so quickly. Is that
foreigners? It's just completely dominated by foreign activity.
Yeah, I'd probably say so.
Foreign sentiment changing.
I'd probably say so. And if you kind of take South Africa into context, you'll kind of see that we've got long-term earnings for some corporates in this country, lots of dividend flow, lots of information available as far as an emerging market is concerned, and then lots of liquidity as well. So when people try and find emerging market exposure, they're going to come here and they're going to try and find the exposure. But that's money that can leave very, very, very quickly. And as a matter of fact, if you look at price to earnings ratios at the moment, just for the three big sectors in South Africa, there you can see them on your screen at the moment. The red line indicates price to earnings ratios for industrials in South Africa, resources is in green, and then financials is in blue. And I've gone back a little bit further here, back to 2011. But if you just have a look at where those are at the moment, there you can see resources, price to earnings ratio of 8 times earnings, certainly in deep value territory. Financials, average at about 12 times earnings. That's about the JSE All Share average price to earnings ratio. And then if you look at industrials, up at 15. Now, if you just look at that picture, something has to give at some point. Something happens. And you need one corporate. And I mean, it was classic this week. Our ABSA came out with an earnings warning and said, listen, things aren't as great as what we think they are. You know, things might be a little bit tough. And immediately, bang, all the banks start selling down. And I mean, ABSA is obviously more punished than the other ones. And you start seeing kind of them dropping from those low teen price to earnings ratios back into the single digit price to earnings ratios.
So what I'm hearing right now is we're getting ready for a reversal in this positive trend. Is that it? Or are we just looking for slower marginal gains?
Well, I mean, Roland can chat us through what some of his thoughts, because from an equity strategy perspective, but certainly from a portfolio construction perspective, you know, if you've got a little bit of cash available, you know, maybe that's not a bad thing. And I mean, I'm talking if you're going to be looking at buying global equities or you're going to be buying local equities, there's enough bad news in the system to warrant you at least just having some cash available. We don't have, and I suppose if you look back to the beginning of this year, it looked like the EU summit was working, it looked like the wheels of the economy was going to start working again, and things were just going to progressively start getting, you know, better. And we potentially have some smaller issues kind of at play as we saw the year unfold, but these are big issues we're dealing with. You know, if
we're not just talking about the European crisis, we're also talking about the US market, and being in America, all they talk about right now, apart from the election, apart from immigration issues and everything, is this US fiscal cliff. At the end of the year, $540 billion in tax benefits expire, and that's also seen to be a big problem, taking money out of the hands of the consumers. Roland, do you take a look at that big, scary number, and do you worry about what a US market slowdown would mean for South African markets?
I think if you're looking just at the momentum of US markets, it's probably due for some consolidation. The big issue is, as I said earlier on, is national healthcare and this fiscal change or these tax cuts that are coming to an end. But that is why I said earlier on that the politics, it's going to be a lot more smoke than actually stuff happening on the ground, and generally people just stand back and wait. So I think the second half of this year, if people want to invest in something, equities from a risk-adjusted perspective aren't the best option. You're going to get some return, but it's going to be very volatile. So probably a better option would be property and bonds, because you're going to get a much more consistent kind of payout from those.
We've seen South African bonds rallying though this
Exactly.
year. Can they continue to sustain the levels that they've reached? And of course, what the R157 sitting at around 6% that yield. Surely that's a level that we have to start questioning.
Well, again, you've got to probably at the margin look at what the foreigners are thinking about our bond market, and certainly our currency experts are saying that the rand is probably due for some strengthening in the second half of this year. So if that's true and foreigners are chasing yield, which they probably are because they're not getting many returns elsewhere, they probably right now looking at the South African bond market as a very attractive alternative. So domestically, fund managers might say bonds have run a bit, let's maybe hold back. I think foreigners are going to start looking and coming in again at the market.
They have been already coming in.
They have been, yeah.
Well, I think it was almost 22 billion rands worth of bonds bought by foreigners, and that's on a net basis in June alone. So
yeah, I don't get net bond buying at this point. Honestly, I don't. It's
and whether that money has actually come into the system is also a question.
Yeah, no, absolutely. I mean, if you've got a bond, if you're going to have a bond run in Europe and you've got these massive debt numbers that you're speaking about in the Western world, if something happens to those debt markets, you'll have a knock-on effect elsewhere. And you always see that happening. Something happens in Europe or something happens in the US, and you've got this knock-on effect that happens in the emerging market space. And so I don't know if bonds are something that I'd be looking and putting on the radar screen. If you're in a diversified portfolio, if you own some of them, by all means, but it's certainly not the classic kind of buy signals as far as bonds are concerned. Equities for me, especially if you go look at dividend yields and there's very high dividend yielding type stocks, they still provide better, a better earning stream or income stream.
So what's horizon though? Because we're running out of time here. So you have to horizon in terms of getting into equities at this point in the year.
Well, Samantha, you're going to get into equities if you've got at least 5 years, because you mitigate most of your probability of a downside by being in 5 years. And the next 5 years is going to be a fairly tough space to be in. So you gotta be in equities for for that midterm period. And I'd even say if you increase it to 10 years, even better, because then you can see the compounding effect seriously taking effect.
Do you agree with that? We've got 30 seconds.
For the rest of this year, low beta defensive kind of play has to be your equity exposure, but look at other higher yielding, less volatile opportunities as well.